Emerging markets. You hear that term and you think energy, right?
Yeah.
Rapid growth, maybe expanding your investment horizons.
For sure. Getting beyond just the usual developed economies.
And that promise of diversification,
Yeah.
not keeping all your eggs in one basket, even if it seems like a safe one.
Mm-hmm.
But, okay, let's get real for a second. What are the less obvious dangers, the things lurking beneath the surface in this exciting territory?
Right. Because getting a handle on those potential downsides, that's not about being negative.
No, it's about making smart moves. Seriously smart moves with your money.
Precisely. The upside is definitely compelling, no doubt.
Yeah.
But having a sharp focus on the vulnerabilities, that's just essential for any investor looking at these markets.
Okay, so let's start basic. What exactly is an emerging market economy? When we say that, what are we talking about?
Good question. So based on our sources, like Investopedia, we're looking at economies that are in a big transition.
A shift, yeah.
Yeah, a fundamental shift. They're moving away from being, mainly low income, less developed, often farming based.
Towards something more modern.
Exactly. Towards being modern, industrialized nations, aiming for a much higher standard of living for their people. It's like watching an economy really find its feet, hit its stride.
And there are signs you look for, key indicators.
Definitely. Things like having a stable, unified currency, that's a big one. A functioning stock market, so companies can actually raise capital.
Right.
A private banking system. And all this while they're actively, building up their industries.
Okay, got it.
And it's this whole process, this rapid change, both economically and structurally, that creates both the exciting opportunities and the instability we need to unpack.
Right, opportunity and risk, hand in hand.
Pretty much. So for this deep dive, we've pulled together insights from a few different places. Investopedia gives us the basics definitions, a broad look at the risks.
Okay.
Then there's a piece from Moringa, that's a financial consulting firm. They offer more practical strategies for, analyzing and managing the risks on the ground.
More hands-on stuff.
Yeah. And for a really specific look, there's a research paper by Chen and Zhu. They get into the nitty-gritty of currency risk, which is huge in emerging markets.
Ah, currency risk. Always tricky.
You bet. And finally, we'll touch on a survey from Durgee Park. It kind of pulls together a lot of academic research on whether emerging markets really offer that portfolio diversification everyone talks about.
So a good mix of sources, definition, risks, strategies, currency deep dive, and diversification evidence.
That's the plan.
Okay, so our mission today is pretty clear then. We want to explore that really appealing potential for high returns. Can't ignore that.
For sure.
But we're also going to seriously dig into those risks, the ones that maybe don't always get the headlines. The goal is to give you, our listener, a much clearer, more, let's say, nuanced picture of what you're getting into.
Okay, let's start with the appeal. Why are investors drawn to these markets in the first place? What's the big attraction?
Well, the number one thing has to be growth, doesn't it? Just sheer economic expansion potential.
Absolutely. Faster GDP growth compared to more mature economies. Both Investopedia and the Moringa piece really hammer this home.
And that faster growth, well, that can mean bigger returns for investors,
Yeah,
right? It's
yeah.
pretty direct.
It can be. You've got whole new industries, maybe just starting up, consumer markets exploding. It can feel like really fertile ground.
Yeah, you can almost picture it.
And it's not just the speed of growth, is it? It's also about diversification.
Yeah.
Adding that layer to your portfolio.
Right. Less reliance on just, say, the U.S. or European markets.
Exactly. Spreading the risk. If one region hits a rough patch, another might still be doing well. It can potentially smooth things out for your overall portfolio.
And the types of shocks might be different, too. Like, what hits an emerging market hard might not be the same thing that rattles a developed one.
That's a great point. Things like, say, commodity price swings can disproportionately affect some emerging economies, whereas developed markets might be more sensitive to, I don't know, central bank interest rate hikes. So having exposure to both can be genuinely diversifying, especially in certain global economic climates.
Makes sense. And the consulting article, Moringa, they pointed to specific sectors that are really taking off.
They did. Areas like tech, which is booming almost everywhere, but especially with room to grow in emerging markets. Also renewable energy, huge infrastructure projects.
These aren't just like short-term fads. They represent real long-term growth areas.
Precisely. And they even named some names, didn't they? Mentioned countries like Brazil, India, Indonesia, China, South Africa as examples of markets with significant scale and still a lot of untapped potential.
Okay, so the potential is clear. Growth, diversification, exciting new sectors.
But, and it's a big but.
Yeah, here comes the other side of the coin.
As we said at the start, that tempting prospect of high reward almost always comes bundled with, well, more risk. We have to navigate what Investopedia calls the inherent risks.
All right, let's unpack that labyrinth of risks then. Seems like there are quite a few layers. Political risk.
Hmm.
That feels like a big foundational one.
Oh, absolutely. Government instability, sudden policy changes, maybe a new tax law or regulation pops up unexpectedly, even regional conflicts.
Yeah.
All of that can seriously impact the business environment and ultimately the safety of your investment. A sudden change at the top can just throw everything into chaos for investors.
And then there's straight up economic risk. That feels like a constant possibility in some places.
You're talking about things like inflation suddenly spiraling out of control, wiping out your returns.
Or the currency just tanking.
Exactly. Currency devaluation, or even a full-blown fiscal crisis where the government struggles to pay its debts. That sends shockwaves.
And the Chen and Zhu paper specifically mentioned currency volatility, right? It's often much higher in emerging markets.
They did. That high volatility in the exchange rate can just erode your gains so quickly if it moves against you.
Which ties into regulatory risk too, I suppose.
It's closely linked, yeah. Frequent or just unpredictable changes in economic policy, tax rules, trade agreements. It creates a ton of uncertainty, especially if you're a foreign company trying to operate there.
What felt like a good environment yesterday could suddenly become really difficult.
Exactly. And another one, maybe less obvious, is liquidity risk.
Meaning how easily you can sell your investment.
Precisely. How quickly can you convert your assets back to cash without taking a big hit on the price? In many emerging markets, the financial markets are just, well, less developed. Fewer buyers and sellers.
So it might be hard to find a buyer when you need one, or you might have to accept a lower price.
Right. And Investopedia points out this can also mean higher trading costs, like broker fees. It all adds up.
We should probably also think broader, beyond just finance and politics,
Wow.
like social and environmental stuff.
Definitely need to. Issues like major social inequality, the impacts of climate change hitting certain regions harder, or even just inadequate infrastructure roads, power grids.
These might not show up immediately on a balance sheet.
No, maybe not short term, but they can have huge indirect long-term effects on businesses and whether investments are truly sustainable.
Okay. And what about inside the companies themselves? Corporate governance.
Ah, yes, that can be a really significant worry in some markets. You might find situations where the interests of the company managers or maybe even government officials connected to the company.
Take priority over the actual shareholders, the people who own the stock.
That's the concern. And Investopedia mentions things like restrictions on takeovers. If management doesn't feel the pressure of potentially being bought out, they might have less incentive to perform at their absolute best for shareholders.
Which could mean lower returns for you, the investor.
And that weaker governance framework, it can also, unfortunately, increase the chances of, well, things going badly wrong, bankruptcy, or just sudden sharp drops in value.
How so?
Investopedia talks about less robust checks and balances, sometimes weaker accounting standards or enforcement.
So it's easier for problems to stay hidden?
It can be, until they suddenly erupt and the value collapses. Plus, think about borrowing costs, because these markets are seen as riskier.
Companies have to pay higher interest rates on their bonds.
Often, yes. To attract investors, they have to offer a higher yield, which makes borrowing more expensive for them and actually increases their own risk of defaulting down the line.
Okay, wow. Lots of interconnected risks. Now, you mentioned currency risk earlier, and the Chen and Zhu paper focusing on it. Let's dive back into that.
Right. This is crucial. The simple fluctuation in the exchange rate between, say, your home currency like dollars or euros and the local currency where you've invested.
That alone can make or break your return.
Absolutely. It adds a whole other layer of volatility, potential gain, or potential loss, completely separate from how the underlying asset performs.
And what was that interesting finding from Chen and Zhu about how investors actually manage this risk or don't manage it?
Yeah, this was really fascinating. They looked at global bond funds that invest in emerging markets and found that, yes, many of them use short-term currency forwards. These are contracts to exchange currencies at a set rate in the future.
Okay, so they're hedging, trying to lock in an exchange rate.
Well, that's what you might assume. But here's the kicker. Chen and Zhu found that, on average, these funds weren't necessarily just straightforwardly hedging their existing currency exposure from the bonds they held.
What were they doing then?
Their analysis suggested that many funds were actually taking net long positions in the emerging market currencies using these forwards.
Long positions, Meaning they were betting the currency would go up.
Exactly. So instead of just protecting themselves against the currency falling, they might actually be increasing their exposure, speculating on the currency appreciating against their own base currency.
Whoa. So they're adding another bet on top of their bond investment.
It looks that way for many of them, yes. Kind of amplifying their potential currency gains, but also their potential losses.
That completely changes how you think about them using derivatives. It's not just insurance, it's potentially speculation.
Right. Their research suggests that while things like risk-return preferences and maybe capital controls in the country explain some of the forward usage,
There's more to it.
yeah, there's a big difference between funds. Some clearly act like hedgers. They're trying to neutralize the currency risk from their bonds. But others act more like speculators, actively trading the currency forwards, hoping to profit from appreciation.
And this speculation, it must have consequences for the market itself.
It seems so. Chen and Xi found that currencies seeing more of this speculative pressure, these net long positions,
Yeah.
they tend to offer higher returns if you don't hedge them. But, and this is important, the cost of hedging against a fall in those same currencies can shoot up dramatically during stressful times like global uncertainty or local regulatory changes.
So when those speculative bets might be unwinding quickly, it suddenly becomes very expensive to protect yourself.
Precisely. It's a critical point. This interplay between genuine hedging needs and speculative currency bets really affects how these exchange rates behave and how much it costs to manage that risk.
Okay, so we've painted a picture of, yes, significant opportunity, but wow, a really complex web of risks too.
Hmm.
For someone listening, thinking about dipping their toes in, what are some concrete ways to approach this more safely? That consulting article from Omaringa had strategies, right?
Yes, they really emphasize being proactive and informed. Their first big recommendation is country-specific risk mapping.
Game.
Basically, doing deep homework on the unique risks, political, economic, social, environmental, for each specific emerging market you're considering. It's definitely not a one-size-fits-all situation.
Makes sense. Don't just lump them all together. What else?
They also stress constantly monitoring key economic indicators, keeping track of inflation, GDP growth, trade balances, what the central bank is doing.
Looking for warning signs, basically.
Or opportunities. Watching these metrics helps you anticipate shifts, and it's not just the big picture. They also advise analyzing specific sectors within each country, figuring out which ones look promising and which might be more vulnerable.
Identifying growth spots, but also potential trouble spots.
Exactly.
And diversification always comes up in risk management.
Absolutely. The classic advice. Don't put all your eggs in one basket. Spreading investments across different emerging market countries, different sectors, maybe even different currencies, that can really help reduce your concentrated risk.
What about planning for things going wrong?
Crucial. The consulting piece talks about having contingency plans ready, thinking through what-if scenarios. What if there's political turmoil? What if there's a natural disaster? Having strategies ready to protect your capital.
Having local help seems like it would be a huge advantage, too.
Immense. They suggest trying to form partnerships with local businesses, people on the ground who understand the nuances, the regulations, the culture. That can be invaluable. And they also mention ESG investing, focusing on companies with strong environmental, social, and governance track records. The idea is that these companies might be more resilient and less risky in the long run.
Okay. And managing that currency risk we talked so much about.
Well, the consulting article does mention using derivatives like this forwards for hedging.
But as Chen and Zhu showed, it's complicated.
Very complicated. It's not a simple fix, and you need to understand if you're truly hedging or potentially speculating. So caution is needed there.
So maybe a more straightforward approach, yes.
The consultants also stress continuous monitoring, always updating your view on the economic and political outlook, and maybe a gradual entry. Don't just jump in with huge amounts. Test the waters first, smaller investments to reduce that initial risk exposure.
Okay, all of this. It sounds like it takes a lot of expertise, which brings us to the role of financial consultants themselves.
Exactly. This is where specialized firms can really help. They bring that mix of local market knowledge and global financial savvy.
To help investors figure all this out.
Yeah, to help assess the risks properly, figure out ways to mitigate them, and manage them proactively. They can help tailor strategies to your specific risk tolerance and goals.
Trying to reduce that uncertainty and find the best possible return for the level of risk you're comfortable taking.
That's the goal, yes. Risk-adjusted return optimization.
Now, going back to Chen and Zhu for a moment, Those insights into investor behavior around currency risk were really striking. The hedgers versus the speculators.
Yeah, it's a key distinction. Their research showed lots of funds using those short-term currency forwards, often with maturities even shorter than the bonds they hold.
And whether they're net long or short in those forwards depends on their view, right? Risk versus return, capital control.
Exactly, it shapes their positioning.
So you've got the hedgers mainly trying to cancel out the currency risk from their bonds,
Hmm.
and then the speculators actively using forwards to bet on currency movements, hoping for extra profit.
And the speculators seem to be the more active traders, larger positions, more currencies involved.
That's what the research indicated, yeah. They seem to behave differently, too.
Oh, so?
Chen and Zhu found little sign that the hedgers really changed their forward positions, much based on past currency moves or volatility.
Okay.
But the speculators, they tended to increase their bets on currencies that had recently gone up, kind of a momentum strategy.
Chasing performance.
Looks like it. And they also tended to increase their long bets when currency volatility was higher, maybe trying to profit from bigger swings.
Fascinating. Really different motivations driving what they do with currency. Okay, let's shift gears slightly to diversification again. That Durji Park survey looked at the evidence, right? Is it still a valid reason to invest in emerging markets?
It seems so, but with caveats. The survey notes that, yes, developed markets have become more correlated over time. They tend to move together more now.
Making diversification within developed markets harder.
Potentially less effective, yeah.
Yeah.
But emerging markets often still offer real diversification benefits against those developed markets.
But it's not guaranteed or static. No, definitely not. The key point is that the diversification potential changes. It evolves as these countries' economies, laws, and political situations change.
So you have to keep reassessing it.
Exactly. The survey pulls together loads of studies looking at how different markets move together over time, including during crises.
Any example?
Well, some research showed varying levels of connection between Asian or Latin American emerging markets and developed ones over time. Interestingly, some African markets, maybe excluding South Africa, seemed less connected, suggesting potentially better diversification there.
And even during crises, sometimes the diversification still holds up.
Sometimes, yeah. The survey even mentions studies suggesting that, say, Islamic financial markets sometimes showed lower correlations during periods of turmoil.
Interesting. And does it matter if you're investing short-term or long-term?
It can, yes. The effectiveness of diversification might differ depending on your time horizon. So the overall takeaway is nuanced, but the research generally supports the idea that emerging markets can still be a valuable part of a well-diversified portfolio. You just need to be smart about it.
Okay, we have covered a ton of ground here. Let's try to boil it down. What are the absolute key takeaways for you, our listener?
Well, I think the biggest one is just acknowledging the duality. Emerging markets offer this really compelling, potentially high-growth story.
Right.
It comes packaged with significant, varied, and complex risks. You really can't have one without the other.
And investing effectively means understanding that whole risk spectrum.
Deeply. Political, economic, regulatory, currency, all of it.
And not just understanding, but actively managing those risks using the kinds of strategies we talked about.
Exactly. Using those tools, whether it's diversification, contingency planning, or careful monitoring. And as Chen and Zhu showed, really understanding what's happening with currency exposure, whether funds are hedging or speculating.
And remembering, based on Durji Park, that diversification benefits are real, but also dynamic, not set in stone.
Right. It requires ongoing work.
So I guess the big aha moment is realizing that high returns usually mean high risk, especially here, and making smart decisions demands serious homework.
Thorough due diligence, absolutely. And for many people, that might mean getting help from financial consultants who really specialize in these complex markets.
Okay.
So maybe the final thought to leave you with is this. Given how dynamic these emerging markets are and how much speculation seems to influence things like currency movements, how should you, as an informed investor, keep reassessing your own risk? How do you keep refining your diversification strategy in this constantly shifting landscape?
What new questions does all this raise for your own approach?
Yeah.
Where will you look for the answers?